Hello, I'm Troy Harmon. This is Nick Antonucci, and this is your market update from Henssler Financial for the month of March 2018. Nick, what in the world, man? The market is on a roller coaster, huh?
Yeah, February was kind of a rough month for stocks overall, not just large caps or not just small caps, kind of
We're starting
across
March
markets.
off in the same manner, right?
We are. We're actually negative year to date for large cap, the S&P 500, the mid cap, and the small 600 as well.
Yeah.
As of today, at the time of recording this, it's been kind of up in positive territory, back below. But let's talk about February a little bit. You had the S&P 500. We had our first 10% correction in quite some time.
Yeah, more than a year and a half.
Yeah, and the S&P 500 was down 3.69%. For the month of February, you had mid-cap stocks down 4.43% and small cap down just under 4%. So it was definitely a turbulent month.
Yeah, especially when you consider that January was so good. By the 26th of January, we were up over 7%.
Yeah, we rallied
8%.
straight from the close of 2017 into the new year, and it started off to be a great foot. But I think it's important to kind of recognize the fact that things still tend to look to be in firm shape, good shape. As far as the economy is concerned, we're coming out of our first earnings season, and earnings season was pretty strong. Earnings were up, what, 15?
Yeah, 14.6%. So earnings actually were really good. And if you look, I mean, some of the few sectors that were positive, information technology was
no
still
surprise there, and it continues to lead sectors year to date.
So, you know, the overall market has earnings growth in the fourth quarter of 14.6%. Earnings in information technology, 22 plus.
Absolutely. Right? Then you look at some of the sectors that had easier comps. You know, energy prices have been suppressed for some time. Earnings growth in the energy sector was up 115%. It's kind of hard to calculate that when the numbers were so low before, so you have to kind of take that into account.
Yeah, we call it easy comps, right?
Absolutely. But let's look at consumer discretionary, up over 10%. So across the board, every single sector showed positive earnings growth. So there's a good thing to recognize in that.
Yeah, consumer discretionary, a little bit surprised there, except for the fact that we do have new tax changes. The consumer still seems pretty healthy, has a great outlook going forward.
Yeah, that should mean extra money in your pockets at home, and hopefully you'll go out to the stores and spend on that and kind of drive the economy further.
All right, so let's move on to some housing news. What you got?
Yeah, February wasn't a great month for housing. We saw new home sales drop. We saw existing home sales drop. The one bright point that we saw was in building permits. You saw a tick up, but again, that was in multifamily, which is kind of the trend that we've seen. If you take a longer term look at it, the trend we've been seeing is in multifamily. You've seen apartment buildings go up all over the place, and that's largely what drove permits in the month. I think a lot of this has to do with you are seeing mortgage rates come up. The 30-year mortgage rate right now is around an average of 4.52%, and that is much higher than the 12-month average of 4.16 that we've seen over the last 12 months. Yeah. So that's obviously going to make the cost of owning a home increase and make people kind of second guess, hey, can I afford to own a home at this time?
Yeah, no doubt. It does slow down consumption a little bit. We expect that as rates get higher, that it'll slow down corporate consumption as well. We do have some other things going on. There's always a plethora of things that are happening in the background. Part of it, like I said, is tax regulation changes.
Sure.
And then we have rising interest rates, which do not hurt somebody that's looking to save money and invest their money. We can get a 5-year CD right now at about 2.7%. So,
right, much better than we saw 12 months ago.
Yeah, probably double that. Some of those shorter CDs, the 5 years.
Absolutely.
All right. Also, inflation. We've had a little bit of a kick up in inflation in January. It really hasn't been looking bad, though, lately.
Yeah, CPI ticked up 0.5%. That was higher than the 0.4% that was expected. Then just today we got the latest PCE, which is what the Fed uses to track inflation.
PCE
It was up 1.7% year over year. That 0.5% I referenced, if you look at that on an annualized rate year over year, 1.8%. So we're still well below the Fed's, well, not well below, we're below the Fed's 2% target rate. Inflation is not out of control.
Margin.
Yeah,
You're not bad.
Yeah, absolutely. So I don't know that we'll continue to see an uptick in that. It seems pretty well managed right now, but that's where we are with inflation.
Yeah, so inflation seems in check. We still, you mentioned the Fed options market still saying about 3 interest rate increases from
That's
the
right.
Fed in 2018. Should get one based on the numbers that we're seeing in March, one in June, probably one in November, which is a little earlier than we were seeing. I mean, it's been on the bubble over the last month and a half, maybe as far out as January of 2019.
Right.
So, you know, we're seeing some changes there. Got a GDP number recently, 2.5%, a tick down from the 2.6% we saw on the first estimate of fourth quarter GDP.
That's correct, but in line with what economists were projecting.
Yeah,
They were
it was
projecting
expected.
a slight revision downward.
Right.
And then if you look at the Atlanta Fed model looking forward to the first quarter of 2018, they estimate about 2.58% for first quarter GDP growth.
Now, Nick,
That's
that is substantially
if you look at our
lower.
last month's video, the Atlanta Fed model was forecasting 5.4%.
Yeah, just shy of 5.4. So
But we also did mention that it's not a very reliable number that they
right.
usually come out with. It does vary greatly, as you can tell in the revised number now.
So going forward, what are we talking about for March and beyond?
I think the biggest question is going to be the Fed, because we have a Fed meeting this month, and it seems 86% likelihood, I think, of a rate increase in March.
Very high.
And currently, we have Jerome Powell, the new Fed chair, testifying in front of Congress, and some of his comments, which I don't, you know, people will read too far into sometimes. I don't think they were overly hawkish, but he did mention that if the economy continues to gain momentum, that there's potential for a fourth rate increase. Markets are negatively responding today. We also had news out of President Trump that he's going to impose tariffs on the steel and
25% on steel
and aluminum industry,
10% on aluminum.
on imports. So it's hard to determine what of that's in reaction to the tariff news. Obviously, the market doesn't like tariffs.
No.
As well as, you know, a faster tightening of the economy, of the Fed rather, of monetary policy, is going to weigh on markets as well. So
yeah, the one thing I will say is the tax reform is going to be significant to corporations. I would expect some of that to be offset by some of the more negative news. I can't see, with GDP below 3%, inflation in check, I can't really see that we're going to have some huge increases in interest rates.
yeah, I think a
especially with the
fourth
market
rate hike
reacting
is
like it
pretty unlikely as well. And if you look at kind of the outlay of when they're expected, really, if there were a fourth one, they'd have to bump that November one somewhere between June and November. So maybe call it August before you have 2 months before you raise again. It just seems like they'd have to really squeeze in an extra rate hike in a short amount of time to make it work. But
well, one thing that we've talked about a lot lately, and this will be my final comment, but you know, we've talked about asset prices, especially stock prices, being as much as 40-some% over their long-term average. Right now, they've come well down from that, around 32%, which it's still 32% premium.
Yeah, it is.
I mean, you know, the market is still pretty expensive, so I wouldn't worry too much about prices coming in line with what we would expect over the long term. So this has been your market update from Henssler Financial. Thank you for watching.